Mike Dever, your host today for Money Matters TV. I'm founder and president of Brandywine Asset Management, an investment firm and fund manager outside Philadelphia, Pennsylvania. Our guest today is going to be Erik Swenson of Retirement Plan Solutions. And I think it's going to be a really interesting show because he's got depth of knowledge on saving and planning for retirement, ensuring that you have enough money to live proper lifestyle in retirement. And Erik's going to show us how to do that because he's going to be coming in from Costa Rica, where he has a home. So before we get started, I want to go to our viewer question today. And that viewer question comes from Jeff Baldwin in Boston. In capital markets, what is the difference between primary markets and secondary? So, Jeff, it's pretty straightforward. Primary market is when a company, for example, NVIDIA or Microsoft or Facebook decides they're going to go public and they're going to issue their stocks for the first time to the public, not just to insiders. And that's in the form of an IPO, for example. That would be a primary market where that company brings the money in from the public. The secondary market is everything that happens subsequent to that. For the most part, it's just people trading on the New York Stock Exchange or on the NASDAQ and trading those stocks among each other. That facilitates the liquidity in the stocks so that those companies can maybe offer more money in a secondary market. But for the most part, that money doesn't go to the company. That's just money traded back and forth between investors. So now, if you would like to pose a question to Money Matters TV, here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Okay, now I'm very excited to welcome our special guest today, Erik Swenson from Retirement Plan Solutions. Hey, Erik.
Hey, good morning, Mike. How are you?
Very good, thank you. And of course, I had to point out that you were, you're not retired, but you're living where people would probably love to go to retire.
Yeah, I would guess there's probably a few degrees difference in temperature between where you are right now and where we are in Costa Rica. And if we have a chance at the end, I might turn my screen, but I'm looking over the Pacific Ocean. It's about 200 yards off the front of our home. So it's a
beautiful,
nice and very comfortable place to be.
Yeah, that's great. Well, congrats on that. That's fantastic. So Erik, you've got a wealth of knowledge and experience in retirement plans. Very specifically, it's potentially a different type of investing than somebody might do just with their non-retirement account. There's obviously a number of risks associated with saving for retirement. And I guess, let's start out by talking about those and, what are the risks and how do you go about solving for those?
So, Mike, thank you. If you don't mind, our compliance department has asked me to read this this 10-second little blurb before I jump in.
Yeah, so 3 pages, I think. I don't know if I would like 3 pages, but
I wouldn't want to be reading it either. So from a compliance standpoint, I will be stating my opinions and beliefs in a truthful and accurate manner, none of which are intended to represent or be construed as a recommendation to purchase or sell any securities. Okay, we've met that requirement now, so we can move on.
Very good.
You mentioned both retirement plans as well as basically individual investing. And typically those are two very key cogs in the totality of what people accumulate in their lifetime to prepare them for the retirement they desire. And actually, our firm is a smaller firm intentionally. I've been in the business for over 40 years at this point. I've had the benefits, so to speak, of seeing and living through things like Black Monday. Market was down 33+%. The dot-com crisis, market was down 49%. the global financial crisis, which probably more people experienced, down 56% at its worst, and the COVID at 33. So my point is I believe that typically people have awareness of how to invest in general, but when you get anywhere near retirement, and this is where kind of the corporate retirement plan and the private client assets come into play, there's something called sequence of return risk, which hasn't been talked about a lot in our industry over time because there really haven't been very many solutions for it. So historically, the tools we've had to work with to create allocations to help people make it through, so to speak, have been some type of a stock, whether individual stocks or mutual funds or ETFs, some type of a bond or bond fund or ETFs, and cash. So when we have years when the market's down, even if we're down less than the market, there's significant risk there. Then there's years like 2022, where both the stock market and bond market are down. And while that's not uncommon historically, there is a challenge for those of us that are anywhere near retirement. If we could ask for the graphic, I'll explain through the graphic what the sequence of return risk is and how it works. We'll probably have a graphic in just a moment.
Yep. Hold on 1 minute.
No problems.
There we go.
Okay. So this is a page from JP Morgan's Guide to the Markets. It's a document they create and update monthly with helpful information. And this talks about sequence of return risk. And what I'm going to do is ask you to look at the chart on the bottom for a minute, because what we're going to see there is we're going to see three different investors, all of whom had 30 years of retirement, which is probably fairly common, maybe even a little bit longer than some experience. And if you can see the small print on the right-hand side, they all averaged a return of 5% per year during their retirement, which is great. So you would think they would end up in very different places. So let's talk about the first guy, kind of purple-blue on my screen. That guy was pretty fortunate because he started off with some pretty good years, then he had some up and down years, and he got whacked pretty hard, to use a technical investment term, the last year especially. Now, the middle guy, my late father used to use the term Casper milquetoast, so to speak. He was just looking for something very simple, and he averaged exactly 5% every year. Now, the person in green, the gentleman in green on the bottom, if you look at the purple up on top and invert it exactly, that's what that guy experienced. So he started off with a pretty rough year. The first couple of years were fine, but over time he did well, and he really potentially kicked butt, another technical term, of course, the last several years of his life. However, if we incorporate spending, which is a very important part of our planning, having enough assets is important, but making sure they last and allow us to maintain our lifestyle throughout retirement is a very big challenge. So let's look at the guy in purple for starters. They all get to retirement with $1 million. They all potentially experience 30 years of life in retirement. That gentleman, if you can see the numbers, did pretty darn well over time. He got hit a couple times, but at one peak at about 22 or 23 in retirement, he had about $2.4 million. However, between the withdrawals and the market correction at the end, he got hit pretty hard, ended up with about $1.6 million. So we could feel sorry for him that he lost several $100,000 that last year or two of his retirement. But on the other hand, I think we would characterize this as a win. He was certainly able to maintain his lifestyle throughout retirement. Now
and
we'll
he
go to
actually,
Casper
we're
Milquetoast.
looking at that real quick, Eric. So he actually accumulated more money even through the withdrawal period in his retirement.
Correct.
And that's because
So
he
when the
started
super-
out with a great head start in retirement with some good strong gains, I guess. So he's not depleting
Exactly.
his assets. Right. Okay.
Yeah, very, very important. It's easy to look at kind of the mountain of money that people have accumulated, but to be able to account for market fluctuations, especially 5 to 10 years on either side of retirement, but for our clients, even throughout retirement, it's important to maintain an upside opportunity, but to really be careful with the downside. So that leads us to the Casper milquetoast, who didn't want any drama. He or she wanted their 5%, and they got it. And they had their 30 years of income with no problems and ended up with $600,000. So he, of course, could have had a little bit more, about $1 million more, if he would have been a little bit more focused on the market, but he just wanted guaranteed returns and he got what he wanted. Now, the gentleman or the woman, whoever that might have been in green, fared a little bit differently. The good news is, if you look at the last 6 or 7 years, had they had any money left, they would have done great. But by maintaining the same withdrawals as the other two individuals, you see that about 23 years in, they ran out of something green, and that's money. And this is what happens sometimes when people are planning for their retirement. They focus on having enough of a nest egg, but they didn't focus on investing in a manner that would protect their nest egg so that they could maintain the lifestyle that they desired. And this is a big focus of our firm. Having been in business for over 40 years, I will say one of the greatest gifts of my career, I will say personally, has been to walk through retirement with people that I met in their 40s and 50s, who then were their 60s and 70s and 80s, some into their 90s. Our goal is to always be as helpful to people as we can. And the early years, it's investment only. Over time, when the twos, typically one maybe has a health issue, and then the two become one, and then eventually that one has a health issue. We're well aware that financial stress and health are the two biggest concerns that people have in retirement. So when we are able to define ways to address sequence of return risk, we're helping them be at rest. So no matter what's happening in the market, they know they're going to be okay. It's hard to put a value on that when you're in your 50s and 60s, because you feel like you're almost fearless. You've got your mountain of money, but you get a decade or 2 or 3 into retirement, and if you don't plan for those things, it can dramatically change your longevity of your funds or make you change the way you live and so on, which of course none of us would prefer to have our clients.
Right. So this obviously then begs the question, how do you protect against or solve for this sequence of return risk? And in that discussion, you could just enter into some sort of a structured product that says we're going to pay you so much every year. Now you don't have to worry about the sequence of returns. You're just getting it. But I'm guessing in that environment, how do you adjust for inflationary shocks or problems? You actually need to make more money over time to live the same lifestyle, to support it, right?
Correct.
So what is
Correct.
what is there? Is there a solution, or is it a constant trade-off, or can you adjust for these risks and solve for this?
So great questions. And I'll start by saying when we work with our clients, we always begin with a financial plan and keep them updated over time. And our financial plans include Monte Carlo analyses. So they're really looking at the risk characteristics a lot carefully throughout their retirement to make sure they're doing well or able to maintain their lifestyle. And I think the biggest key that we have found is about 7 years ago, a company came out with something called a buffered product or buffered investment. And a buffered investment is I'll spend just a moment explaining what they are, because we'll talk about them for a few minutes. They're a huge tool for us. We began within 2 or 3 years after they had some life underneath them, and we were able to get a nice assortment of them to choose from for our clients. We utilize them in virtually all client portfolios where our clients are 50 plus. And the majority of the clients that we manage their funds for are now in retirement, and we continue using them throughout retirement. So a buffered product, the primary form that has become the most popular are ETFs. So they're fully liquid. You can buy them and sell them at any point in time. But what they do is they utilize option strategies that create 2 different potential benefits. One potential benefit is the buffer or the protection. So for example, let's just say, Mike, that you're my client and you guys are retiring and we decide it's appropriate to have some of these. We'll chat with you for a bit. We'll have the rest of your financial awareness because we're talking about it. We'll have your financial plan in place. And we might decide it might be helpful for us to incorporate maybe a combination of 2 or 3 or 4 or 5 of these types of investments based upon different indexes and based upon the buffer characteristic or the risk protection. So we might decide we want to be a little careful here. This is the most common strategy we've used for most of our clients in the last couple of years, is we'll typically select a 15 or 20% annual buffer. So we purchase an ETF, let's say, again, it's for you, Mike, and maybe we have an upside, which I'll get to in a minute, of a certain cap. There's a maximum percent they can earn. But if the market would be down in that period of time, let's say that we got a 15 and a 20% buffer. We did two of those for you and your wife. And let's say the market was down 17% that year. When we get to the anniversary of those two, you're going to see your value go down during the year. But when we get to the anniversary, the one that had the 15% protection is going to be, or 15% buffer, is going to be down 2%. The one that had the 20% buffer is not going to be down at all. You're going to start the new year where you began the prior year. So we incorporate typically at least 2 or 3 of these into each of our clients' portfolios, sometimes more depending on the individual characteristics, to help you get the exact protection you'd like. At the same time, you wonder what's the catch? Well, the catch is we don't get all the upside. These types of arrangements typically have maximum returns in a given year. They're called caps. So your return is capped. In the last couple, 3 years, we've seen caps of probably 11, 12, 13%, maybe 14%. Those have been common for us. A lot of these are issued either monthly or quarterly, and they change from month to month or quarter to quarter. Some are issued on things like the S&P 500 or the NASDAQ. Some are the EFA Developed Market Index or the Russell 2000 or the Russell 1000. Almost any index today has a buffered investment that allows us to provide probably the majority of the upside returns over time to our clients while providing some very nice annual protection along the way. So how does that sound for the time being? Does that make sense?
Yeah. So it sounds good, except that markets are lumpy with their returns, right? So you're not going to make 10% a year. You're going to be flattish
Correct.
or up a little bit, and then you're going to have like we've had in the last 3 years. So what
Correct.
that would have to do then over the prior 3 years, what we just finished here, then instead of mid-20s returns and high teens returns, they might get half that return.
Correct. It certainly depends on the individual markets. And so what we do, again, let's assume that you and your wife are clients of ours and we're managing your whole portfolio. We'll know what your assets are. We'll know what your income needs are today. And we're going to project typically higher inflation than has been historically typical. And we're going to project typically lower equity returns to be a little conservative because we don't want you to get 20 years down the road and have a bad surprise. So we will actually, to this point, we've had a solution that's worked very well for us. We will integrate equity ETFs primarily, or other investments, mutual funds, and so on, that will achieve the full upside returns, but they will also be subject to this point to the full downside returns. So the percent that you might have, let's just say that there's 5 clients we have that all have the same amount of money you and your wife have. Let's say it's $1 million or something like that. Depending on your other income sources and other assets that might be there or possible inheritances that might come, the balance of the unprotected equity investments versus the buffered will be different for us. I've intentionally created our firm. Our firm was 21 years old last year. My deceased father and I created our prior firm that I had for 14 years before. We have a choice of how big we want to become. Our intent is to always be small enough that we can address our clients' needs in a way that we'd want to be addressing if we were in their shoes. So my point is we will customize portfolios on an individual client basis. But there's a big asterisk that I'm going to be sharing briefly. So we're independent. We have access to virtually any financial product, more or less, in existence. And we keep an eye out for newer things like the buffered investments. We gave them a couple of years. We waited until more companies were issuing them, did a lot of due diligence, and they've worked well for us. There's an institutional investment firm that we've been familiar with for probably 5 or 6 years that we think highly of that has a unique expertise. They typically, in their various portfolios for institutional investors, which I'll get to in just a moment, have been able to achieve basically market-like returns, but typically far less downside. They basically have specific strategies that they integrate so that when the market gets hit, instead of being down equally to the up, or equally to whatever the market's down, they're capturing far less of the market downside. I can't share specific percentages, but it's significant. The challenge has been, to this point, their minimum investment has been at least 25 million historically per client, and most of our clients don't. That wouldn't work for most of our clients. That firm actually, sometime in the first half of this year, likely in Q2, is going to be sharing those same strategies in a series of ETFs. And as we've been tracking them for years and we are aware that they're going to be sharing the same strategies, we will now going forward be changing the way we manage our client portfolios. Again, we used the buffered investments in the past. We still will on a customized basis, depending on the individual needs of each client. But for the unprotected or the unbuffered investments, our intent is to have the ETFs from this institutional firm probably replace the majority of our equities, so our clients that we typically currently use, so our clients can not only potentially experience the same upside if their performance continues to be similar in the future that the market achieves, while at the same time experiencing potentially significantly less loss, even saving 10 or 20 or 30% of a downside from a mathematical standpoint is huge over time. So it gives us another tool in our tool set that we've never had before. We didn't have the buffered before available to our clients. We now will have these available in the next quarter or so. And so we really have the ability to create the exact balance of risk and reward that's appropriate for each client based upon their specific finances and the financial plan that we create.
I mean, it is nice that you've got transformational innovations that take place. And, 60 years ago, people were limited to almost like random stock picking in portfolios, the nifty 50 in the 1960s. And then, we had passive come along with John Bogle and Vanguard, and now that's dominating. But as you're pointing out, with sequence of return risk, do you really want to have your portfolio or a substantial portion of that dependent on the emotion of the market, and with passive investing, you have no protection. Your buffers help solve for that. Correct. with a limitation and the fact that they're capping upside performance. And of course, now with the new methods of being able to maintain the unconstrained upside, but still have some downside protection, that's transformational once again within the industry.
Yeah, and I'll share just a quick comment from a clarity standpoint. I mentioned the boutique perspective that I really formed our firm based upon. We have a wonderful team of people with phenomenal expertise, but these are not quite as easy to create, in my opinion, in a cookie cutter manner. When you get to larger firms with no offense intended to anybody, it's hard to do more customized work. It takes more time and effort on an individual client basis. But we don't know of a better way to take care of our clients than to do it in that manner. And so we're able to, again, even if we have several clients that have similar net worth to you hypothetically or whoever else, we still want to make sure we're helping each one solve their specific needs in the best way possible.
Now how would a guaranteed income type product, because I've been hearing about guaranteed lifetime income as well, how would that fit in to a portfolio? And obviously that would seem like it would help solve for sequence of return risk, but maybe not for inflation risk. How does that work in a retirement plan?
Your question is a very timely one, because not only have those types of investments, typically annuities, been available forever, for decades, but there's been a trend the last couple of years in the 401k space. And we run a small number of 401k and 403b plans for basically employers that really care for their employees, including some nonprofits. And the easiest way to comment on this is in the 401k space. There have been some studies saying that employees would like to see these types of tools added to 401ks. So a lot of the 401k record keeping firms are adding something like a lifetime income option. And that can be okay. It's basically not unlike what a pension was years ago. The difference, our awareness is those can be helpful. It's a little more challenging to account for inflation there. And what we do with clients individually, again, let's take you and a couple other people with similar finances. Let's say that the Social Security would be very different, or one has a much different pension. The needs are very different. And so what we typically do is we will combine maybe 2 or 3 or 4 of these types of investments. Maybe one is just a plain lifetime income annuity, so to speak, that'll guarantee payments. You can maybe include your spouse for a little bit less money. There are also investments that our clients have preferred where they don't get quite as much money per month by using those types of tools. But on the other hand, they're not giving up access to their investment either. So to be clear, let's just say, Mike, that we do one of each of these for you. One of these will pay till you and your wife are no longer here, and then the money's gone. From the day you sign the paperwork and the money goes away, you can never access it again, but you'll keep getting the payments throughout your lifetime. The other alternative is something that we've been using for many years for our clients. There are a couple companies that offer this, where you could get something less per month, which isn't helpful, but you still maintain an account based upon whatever stock or bond accounts, so to speak, you have. And so they guarantee the payments over your lifetime. And then at the end of your lifetime, there's a very interesting benefit where, as long as there's any money left in the investment, let's say you start with $100,000 and maybe the market hasn't been very friendly, or you and your wife have lived a really long time, maybe it's down to 5 or 10,000 at the end. We're going to be the ones knocking on your door respectfully and saying, hey, remember we had this conversation with you. If you stop taking money now, your heirs will actually collect the original principal amount. So you're giving up a little bit of the extra income you could have had, but in return, you will never get back less than the original principal amount if there's any positive dollar value in the contract. So if you get to 90 something, let's use my example. Let's say that you or your wife, someone gets to 100, and at 92 or 95 or something, it's getting to be lower. We're going to be reminding you that this is one of the faucets we've utilized. We want to turn this faucet off for a little bit because we know you love your children, and we don't know how long you'll be here for. It probably won't be a lot longer. So it may make sense to consider something like that as well. So again, we could actually help create the exact blend that you need for your income and exactly how protected you need it to be.
I'm sorry to cut you off there, because we have a bunch of other questions we wanted to ask, and we're running out of time. I did want to hit a few other things, but we're not today. This was comprehensive as it was. There is a lot. I just want to point out to people, there's a lot of considerations in retirement. It's great to have a firm like Erik's, that, a boutique firm that can take on your account in a very personalized way. I think that's an important thing. So Erik, I really appreciate your time on the show. Thank you very much. Absolutely. Our next guest on Money Matters TV is Mark Verrill, founder of VPE Advisors. Thank you for watching Money Matters TV, where your money matters.